Roger Montgomery from Montgomery Investment Management. Thanks for joining us.
It's a pleasure. Great to be here, Mark.
Now, 18 months ago, a couple of years ago, we talked about the property market, and you had the traffic light on amber in terms of the Australian property market and whether we're in a bubble. Where do you see it now?
Oh, it's red now. It's a little bit late. In fact, if people want to get out, they've probably left the run a little bit late, particularly for apartments. Houses are fine still, particularly if there's some unique qualities to them. But now I've already had heard anecdotal stories of people, some of whom very, very close to me, who have tried to sell properties in Brisbane and Western Australia, for example, and have received no bids.
Wow.
None whatsoever. So circumstances have deteriorated more rapidly than what the headline numbers suggest, because what most people don't understand is that it's the marginal buyer that affects the price for everyone. So it's the buyer this weekend that determines the price that everyone sees or believes their house is worth, or what they can get in the marketplace. But if all those people believed that and they tried to sell at that price, that their real experience would be very, very different.
So how are you positioning your investments here, given that you've started to see a slowdown in the property market already?
Well, the bigger issue for us is not property prices, although the wealth effect from declining property prices this time around will be significant because of the very high debt burden that people are under, and interest rates. In fact, just as we're speaking, ANZ has just raised their interest-only rate by 30 basis points. That happened at 11 o'clock this morning, and that's going to be followed by the other banks. We'll talk about the problem for the banks.
On investor loans.
That's interest-only loans for investors and owner-occupiers.
Yeah.
We'll talk about why that's the case in a little while. The bigger issue, though, is the end of the construction boom. So as prices start to flatten or fall slightly, the appetite for buying apartments disappears, the bid goes, and developers find that they're left holding a development where only a few properties or few of the apartments have settled. They have to discount. So we saw yesterday in the papers, someone's now offering some sort of a hybrid electric car for the first 10 people who buy an apartment from that development. I know of another developer in Sydney that's offering a BMW i3 in the garage. Right. There are people offering frequent flyer points if you buy an apartment and holiday. So they're already discounting. But the bigger issue is going to be the very rapid change in employment conditions for people in the construction industry. So the construction industry is one of our biggest employers. It employs about 9% of the Australian workforce. That is ending now. So we've already seen a 23% decline in approvals. That will lead to a similar, if not bigger, decline in construction commencements and construction activity, which ultimately will feed into completions, and then from completions to demand for furniture and household appliances and retail spending, through the reduction of revenue for people who are employed in that industry. So that will then have a direct knock-on effect to retail. Retail is our second biggest employer in Australia, and so we are looking at the possibility of very, very slow and even negative growth in the economy. I don't care about that. What I care about is individual companies, and that's what we do here at Montgomery. We're not interested in the macro picture, but to the extent that experiences in individual sectors affect the outlook for individual businesses, we do care.
Yes.
And so where we can directly attribute the prospects of a business deteriorating to something, that's what we're talking about today.
Yes.
So the JB Hi-Fis of the world, the Harvey Normans of the world, the Nick Scalis of the world, they are now over-earning. I sat at a presentation with Richard Murray, who's the CEO of JB Hi-Fi, and no one applauded him when he got on stage, and he was shocked because he said, we've just reported our best numbers. And I think the rest of the market knew, and the rest of the room knew, that's as good as it's going to get.
Yeah.
It might be that JB Hi-Fi's purchase of the Good Guys marks the high point for that particular retailer.
Retailing.
Yeah, and so that's a big issue for us. We're not investing in retail at the moment. There might be opportunities to do so in the future. And remember, we haven't even discussed Amazon and what the impact that's going to have on some retailers. Where, for example, Rebel Sport, which is owned by the Super Retail Group, they about 80% of their best-selling products are already on Amazon. Yes. So when Amazon comes to Australia, that's going to make their competitive environment just so much tougher.
slowing property market also would seem headwinds for the Australian banks as well. So
Correct.
is it as good as we've seen? Is this as good as it gets for the bank stocks as well?
Yeah, so it's likely that by the time this particular interview is published by you, Mark, or certainly within a month or two, within a month of it happening, we'll find out whether or not the banks are required to raise more capital. And between you and me and your viewers, they probably will be required to raise more capital. In fact, I'd bet that they will. And that means that their return on equity goes down necessarily. We also know while they're preserving their net interest margins by raising interest rates, other factors, particularly slowing credit growth and rising defaults, and remember, rising defaults occurring at a low point in their provision for doubtful debts and non-performing loans. So the banks have been boosting profits over the last few years by writing back some of that provision for bad and doubtful debts to their profits. Now the balance of the provision is very, very low just at the time that the property market is about to turn over, which means that non-performing loans will probably start to rise.
So it's much more than just the property prices that have either peaked or are likely to fall.
Construction activity.
Yeah.
So we know, for example, that housing activity leads renovation and alteration demand by about 11 months, 10 or 11 months.
Yeah.
That is now in negative territory. So the volume of turnover, the number of houses and apartments actually trading in the marketplace is now at a negative annual run rate.
Right.
So it's declining. And that in 10 or 11 months' time, we will see that feed into renovation and addition demand. So things like bricks and saws and timber and plumbing and all of those sorts of things that Bunnings and Mitre 10s of the world are selling, that will start to soften. And so they might make that up by increasing volume through discounting, but the margins will be under pressure.
Yeah. So really what you're saying, the tailwinds that we've seen in so many parts of the Australian market, courtesy of the housing boom, is starting to turn into a headwind, and investors just need to rejig.
It's already started. So it's a bit late, as I said earlier. It's a little bit late if you're heavily indebted and you've got a few apartments. I challenge you to try and sell them for what you paid for them all. And I think that's going to be a lot tougher now. We also know that the supermarkets are under pressure. They can't win market share. If they win market share, they have to reduce their prices. You hear this really ridiculous statement coming from Coles and Woolworths saying, we've just invested another 185 million in lower prices. That just means we've just taken money from shareholders and given it to shoppers. That's all that means. And so that's not going away either. We now know that the property developers are going to be finding that their future sales are going to slow, or sales growth will slow at best. And if they're left holding a whole bunch of property, then they may have to market those lower at some point in the future. And we also know that the banks have blacklisted entire suburbs. I know in the case of AMP, it was about 140 suburbs that they blacklisted. There's rumours going around that NAB is sending a list around with 200 suburbs that they're not lending to anymore. Yeah. We've also heard that Westpac just either today or yesterday have just told their entire broking network they're not refinancing any interest-only loans. Now that's a really big problem, because if you've got an interest-only loan and you want to refinance that and the bank says to you, no, we're only going to give you principal and interest, then your payments can go up by as much as 40%. Yeah. And it's a big increase in your repayments just to maintain that mortgage. And so there's going to be, it's going to be some financial stress.
It's a very challenging time to invest in Australia, I think, at the moment, Roger. Yeah. You'd have to agree, and prices are still elevated in property markets and share markets. So
exactly, but globally, there's some great businesses out there. We're seeing expensive relative prices globally, but we also know businesses that are growing. For example, Alibaba just overnight announced that they expect their profits to grow by between 50 and 60%. Sorry, their revenues to grow by 50 or 60% this year. So there's companies out there still growing enormously. And if you think about it, those Amazon and Alibaba and Tencent, those sort of companies, there's 3 billion people with a smartphone now in the world, and they're using those smartphones for more and more things.
And we've certainly been encouraging people to look beyond Australia's shores for investment. This conversation just further consolidates that view. So, Roger, thanks very much for your time and your insights.
Great to be with you again.
Thank you.
Pleasure.